More in the markets and the new highs we've been seeing. Let's welcome Greg Branch. Branch Global Capital Advisors, founder and managing partner, and a CNBC contributor. Good morning to you, Greg.
Morning, Melissa.
So you think in the short term, at least, we're safe in terms of this momentum being preserved?
I do. I don't think we can identify a catalyst that would turn this to the downside in the near term. More importantly, this coming CPI number is probably the most important one we've had in a long time. Those of us who kept our reservations throughout that first quarter, I think when we look back, did so with good reason. Inflation itself was accelerating as we jumped to the top of that 30 to 40 basis points band of month-over-month growth. But more importantly, the underlying metrics were accelerating as well as wage growth jumped from 90 to 120 bips. And we saw jobs numbers in the 300s. Well, that we experienced a market change last month when we saw for the first time 0% month-over-month core growth. And so I think those of us who had a bearish posture all had to take a pause there and said, maybe the Fed is actually winning this. Even after the Fed themselves in the May 1st notes, we saw put the possibility of hikes back on the table.
Right. But as Powell said yesterday, inflation is not the only risk we face. It's also unemployment, and we saw that in the latest report. And so how much of a concern is that for you? Because, unemployment tends to tick up, but when it ticks up, it's a quick turn there, Greg.
You're right, Melissa. So neutral for now. We'll see where we are come the fall. Unemployment has come up each of the last 3 months. We're now at 4.1%, getting closer to that mid-4 range that the Fed indicated we need for sustainable 2% inflation. But that comes with a cycle, and we have yet to enter it. And so we'll see what the environment looks like and how hazardous it is in terms of earnings. Whether we're looking at a very deep slowdown, I don't use the R word, a very deep slowdown, and the length and duration of that slowdown, and where we are versus consensus. That'll be determined, I think, our posture from there.
You don't use the R word out of principle, or you just don't think it's going to happen?
It's semantics. Slowdown, recession, one and the same. When we started this year, we started with a posture of 0 rate cuts for 2024, which was polar opposite of consensus of 6-7. We thought that would be a catalyst. It turned out not to be. It turned out to be overwhelmed by the enthusiasm, not only of AI, but, we've now had two, if this quarter comes in at 9%, we've had 2 strong earnings quarters in a row. But if we go to see single digits or go back to negative growth, how much of a catalyst that will be remains to be seen.
What are you expecting for earnings season? We start on Friday, and then it really kicks into high gear, Greg. Do you think expectations are too high? And I'm thinking in particular of, some of the AI names, the big 7, big cap tech sort of names that have held the market up.
I think consensus has got it right. And I think consensus and what we'll see will play into our long-term view for the year. I think as the year goes on and as we start to enter that economic cycle, the sectors and groups that have put up the 20 to 25% earnings growth will continue to do so. So I think we'll see leadership continue to be narrow throughout this year. When you look at the projections, communication services projected 18.4%, healthcare is projected 16.8%, and information technology is projected for about 16%. When we start to enter that economic cycle, leadership and investors will crowd around those names that can produce 20% earnings growth in a world where everything else is low to mid single digits.